Hi and welcome to Introduction to Financial Derivatives. My name is Müge Türkkan. I'm the Treasury Management Consultant of MT Training and Consultancy. Here we are going to spend some time to give you a sense about the common features of financial derivatives, which are categorized mainly in four types: forwards, futures, swaps, and options. We are going to go over various types of derivatives products and main terms about derivatives by using scenario analysis and case studies. As you may already heard, according to theoretical definition, derivative is an instrument which has a value dependent to or derived from the price or value of an underlying asset. So basically, a derivative is an instrument which is based on an underlying asset. But what do we mean by underlying asset? Underlying assets can be any variable like the foreign currency exchange, interest rates, funds, indices, metals, crude oil, gold, or even another financial instruments. For example, in DCD, the underlying asset is a deposit, or it can be another derivatives instruments. For example, there are some options which has an underlying of futures. And those products are available in some foreign derivatives markets that you buy a futures product, and in order to offset the risk of that futures product, you buy an option with underlying asset of exactly the same feature. Or maybe in order to offset the risk of your swap transaction, you can buy an option having that swap transaction as underlying asset. Also, that underlying asset can be a more abstract thing like the weather or election results or legal rights. Also, it can be part of partnership share of your company. For example, if your company has a foreign shareholder, like a foreign company, for example, has 10% share in your company, then that foreign company can buy a derivative instrument in order to increase its shares once your company makes a profit over 20%. Or if your company makes loss, they can also buy a derivative to sell their shares. And they can fix the price of buying new shares or selling shares from today. So derivatives are instruments to determine and fix a future cash stream or future transaction. They can be used in various styles, and as you see, derivatives has a very large world beyond imagination with lots of underlying opportunities. Underlying assets can also be variable, we said, and it should be measurable. And sometimes it's a financial instrument, as you know. So once the underlying asset is a financial instrument, instead of directly investing in that underlying asset, why do we prefer to invest in a derivative product having that underlying asset as only a part of the product? Why don't we directly invest in underlying asset? The reason is that while investing in derivatives, there's no need to buy that underlying asset. So there's no need for change in ownership. Assume that you want to invest in crude oil, for example. You have some expectations about the price change in crude oil. You don't need to buy barrels of crude oil in order to do that. You can buy a futures contract which has an underlying of crude oil instead of directly investing in that underlying asset. Or assume that you want to invest in an equity index. You don't have to buy all the equities in that index. You can directly invest in a product which has that index as underlying asset. But now you can say that we can do that with some other financial instruments too. That's right. But with some other financial instruments, it may be more difficult to take short position. So another advantage of derivatives is that you can take both long and short positions, and you can invest in both price increase and falls. Assume that you are expecting a fall in the price of gold, for example. You can short sell gold easily by using a derivatives product. Also, another advantage of derivatives is that you can take big position by investing a small amount with the leverage effect of derivatives products, which also makes it a bit more dangerous product than the other financial instruments, of course. But also, by being able to take long and short positions, the opportunities that derivatives give to you increase a lot. But mainly, the derivatives can be used in order to offset the uncertainty about the future cash flows. That's called actually hedging. That's one purpose of derivatives. If you ask why are we trading derivatives, one of the main purposes is in order to offset our risks of mainly FX, commodity or interest. An example, the most common example is that assume that you are an importer and you have a payment 3 months later to your supplier in a foreign currency. And you are anticipating an appreciation, an increase in the value of that foreign currency. How do you protect yourself from that risk? You can buy a derivatives product and fix that currency rate from today for your future transaction. And that is called hedging. Also, if you're an exporter, you can protect yourself from any depreciation in the value of that currency rate. Another reason of trading derivatives is speculation, which is mainly the aim of making profit out of the changes in the price of that underlying asset. And as you can take both long and short positions, you can benefit from both price falls and increases by making speculation. There is also another way of using derivatives, which is arbitrage. Arbitrage is also just like speculation, is making investments with the aim of making profits, not to offset risk. But those investments are about the same underlying assets, and you are actually benefiting from the price differential of the same asset between two different markets. That price differential may seem a bit small to you when you first hear, but if it's combined with a leverage effect, it can make huge profits or losses. The best example for that is the French bank Société Générale. One of the junior derivatives traders of that bank, Jérôme Kerviel, made lots of derivatives transactions having the underline of arbitrage, equity arbitrage trade. But the problem is that the bank wasn't informed about those highly leveraged derivative trades of Kerviel. After 1 year of secret derivative trades, Kerviel has made $7.2 billion of loss. And after that, of course, the bank also learned about it and had to make a capital increase. So that even if that asset doesn't have much price differential in itself, with the combination of a highly leveraged derivative, it can become very dangerous. Now, another question is that we said derivatives are having a value which is derived from or dependent to the value of underlying asset. But is that underlying asset's price is the only determinant of the value of derivative? The answer is no. There are some other determinants which are also having a role in the value of derivative, like risk-free interest rates, days to maturity. As we also talked, leverage and volatility. In this course, we will go very detailed in those two terms, leverage and volatility, which takes place in the formula of derivative. All derivative products have a pricing formula or a structure which determines the future cash flow. And within that formula, you can find those terms like risk-free rate, volatility, leverage, or days to maturity. But there are some other factors which are not taking place in formula, but may affect the value of derivative even more than them, which are the economical environment and market efficiency. What do we mean by market efficiency? The liquidity of the market and the availability of derivatives products are some examples of that. In that course, we will also go through all these, the effects of those factors on the risk level of derivatives. And what do we mean by the economical environment? Actually, economical environment is the most important part of all the trades that we make. It doesn't matter if it's a derivatives trade or any other financial instrument trade. without considering the economical environment or without having any expectation about it, we shouldn't go into any investment. Even if we have lots of information about that product, and even if we are very much informed about statistical data, historical data, and the pricing formulas, it doesn't matter. The best example for that is the LTCM hedge fund. Maybe you already heard about it. LTCM hedge fund, long-term capital management, was established by some economists, and within those economists, there were two important names, Fisher Black and Myron Scholes. Those economists were made and developed the option pricing model of Black, Scholes and Merton. Also, there was Robert Merton with them. And that model was priced with Nobel Economist Prize. So those economists were one of the most authorized names about the pricing of options, and also they were, of course, having lots of information about the statistical data and economical environment. In the beginning, that hedge fund made a high profit of over 40%, but due to some global crises like 97 and 98 crises, the Asian and Russian crisis, the investors started to sell all of a sudden because the global risk appetite had a sharp fall. And once that hedge fund was always trading highly leveraged products, all of a sudden, hedge fund had to have $4.6 billion of loss and had to dissolve and liquidate by the beginning of year 2000. So that example shows us that even if we have a beautiful formula and scientific approach and even strong expectations about the market prices, all mathematical models about financial markets are mainly based on the assumption of the normal behavior of the markets. But unfortunately, markets sometimes unexpectedly doesn't behave normal, and that stability is ruined. That's why even if you are very authorized names about economy and derivatives, you can even make some losses. And that's why in this course, we will never lose our connection with real life. We will always go over case studies and scenarios about different conditions of the economical environment. And also we will go over the monetary policies and their effects on the value of derivatives. Monetary tightening and monetary expansion, how would they affect the demand to derivatives and value of derivatives? We will all go over this. So I should also note that there won't be any promotion of technical analysis or investment recommendation in this course. I would be pleased to answer if you have any questions. Now we can go on with the session of understanding derivatives, tradings and products. I hope you enjoy.